Welcome to the weekly update, where I'll go over the action in the market for the week of February 24th through the 28th, and we'll see how things look for the week of March 3rd through the 7th. Okay, the market's been under some pressure. We've really lacked a lot of upward momentum since the beginning of 2025. Typically, what will happen, historically anyway, on a seasonal basis, is the second half of February can be kind of rough. Now, we had an up day on Friday, but we had a pretty significant down day on Thursday, and we've been turning more negative in the short and intermediate term. We came down on Thursday, and then we went up on Friday right to where we were back on Wednesday. So we had the same percentage loss on Thursday that we saw the gain on Friday. So we've kind of gone nowhere since last Thursday. Our charts are showing some weakness right now. What we're seeing is a gradual shift. Now, we don't know if this is short term or if this is turning into something more long term, where we're going away from growth over into more defensive areas. There's an increase in inflation concerns. There's some fears about growth concerns for the economy. There's all these political things going on right now with the executive orders and the new administration doing all these things that half the country really likes, the other half thinks are terrible. And people are a little bit confused right now as they try to figure out what is happening, not only with the politics in America, but also what's going to happen with the economy. Okay, so we're seeing some weakness even on the weekly charts now, but in the bigger picture, we're still positive, but we're going through kind of a difficult time. Okay, so before I get into all the analysis and so forth, please feel free to check out the videos that I post every day. The things that I talk about here, I break it down a lot more in the daily videos that I do. And we can see these things developing day by day by day. And I put them on YouTube and Rumble, so you're more than welcome to check those out. Now, there is a bit of a delay with these videos. I have a program and I have a website that you're more than welcome to check out. It's still free. And there's a link that I'll provide here in just a moment. Now, once I prepare these videos, they're available to people on the website right away. But I delay putting them out on YouTube and Rumble to give the members the first chance at looking at them. These videos are designed to be viewed before the week starts, or each daily video is designed to be viewed before that day's session. So, if that's something that interests you, you want to keep up on things, you like the way I do the presentation here, feel free. Check it out. See what you think. All right. I also have, and it's free for the time being, just send me an email. You can leave a comment, what have you. If you want to check out the daily and weekly newsletter. Now, when this gets up and going, it'll be $8 a month. I'm working through the format and I'm just going through kind of rough draft phases right now and I'm trying different things. Actually, a week ago, I included a lot of additional newsletters. Not only do I do a video each day and week, but then I also do an intermarket analysis video. I started doing a newsletter for that. I do a deep dive video and a what to watch video, and I do newsletters for those as well. And even when this thing gets up and going, it'll still be $8 a month. I designed them to be short to look at, it doesn't take you a long time to read through it. And the idea is that if you get the newsletter and you go, oh, this is interesting, maybe I better check this out, then you might go over and watch the weekly video or go into one of the daily videos. This is meant to be a way to keep you informed without taking up a lot of your time. And then you can evaluate if you need to dive deeper into your analysis. Okay, then there is a PDF that I make available with every video that I upload. It's in the description, and some folks find that helpful to download and view the charts that way. And then I do have a thing called the SPX investing program, and here's a link. There's also a link below the video that will take you to that. Check it out to see if it's something that's of interest to you. And now every day I post on the YouTube community tab. I can't do this on Rumble, a thing called pivot points. And these are longer term. That's the daily chart that I show. And we're going to be getting new pivot points for March. Once pivot points are set, they last for the whole month on a daily chart. They change every day on an intraday chart, and I post two charts every day on the community tab. You can look at those and see if you find those helpful. I find them very helpful, not only to look at the pivot points for that particular day, but then we look at the monthly ones. And then later on in this video, I show you other pivot points that last for the whole quarter. And those can be very significant levels. I do have a private Facebook group. Not a lot of members, not a lot of activity. If you want to join and change that, it's a way to have some interaction with me if you so desire. And I'm still playing with the idea of maybe disabling comments because anybody who really wants to talk to me, they'll send me an email or they'll contact me through the Facebook group. Or if they're a member in the program, they'll leave a comment that way or send me an email. So I get a lot of bot comments and spam comments and scam comments and I just go through. Once I see them, I delete them and I try to delete them as soon as possible. Now, if you have a legitimate comment that you want to leave, by all means. But if I get some gobbledygook stuff, that goes away pretty quick, or if it's some kind of spam. All right, and then I do post on both YouTube and Rumble. So let's go back and talk about this week. We were down 0.98%. If you round it up, you say we were down 1% for the week. Now, we would have been down a lot more than that had we not bounced up on Friday. So we recovered from where we were after Thursday, at least a lot of the loss. And we were above average with volume. We have been seeing that pretty healthy lately. And we are showing some weakness. On longer term, in the bigger picture, things are positive. That hasn't changed. No matter what the perma bears try to tell you that we're going to have a 60% crash, whatever. There are some things that we're concerned about. And I'll go through that. And I've been going through it in the daily videos. And I'll go through it in the intermarket analysis video and the other videos that I post. Because just for an example, on Friday, I didn't really make this as explicit as I should have, but I watch the S&P 500 and all the strategies and everything I do is about the S&P 500. Well, but in this video, you're going to see charts of the Dow, you're going to see charts of the NASDAQ 100, because sometimes these indexes key off of each other. We came down on a daily chart and we hit the 200 period moving average for the NASDAQ. And then we started going up from there. That is a support level that held. And once it started going up in the NASDAQ, even though we weren't necessarily around a support level with the S&P 500, it turned everything around and things started to go up in Friday's session. So those are the things that we watch for. That's why the videos that I show are longer and I try to show it across the market, even though I'm drilling down ultimately to what happens with the S&P 500. Okay, now interest rates are coming down. Now, a week ago and 2 weeks ago, when I did this video, the stock market was really keying off of interest rates, and we were dealing with the 4.5% level. Well, that fixation has kind of gone away a little bit, and we're dropping with interest rates. Now, the stock market is worried about other things like inflation and these political things that are going on and just uncertainty. We also had an inflation report that came out on Friday that the market took as friendly. They could have taken it as negative. They just decided to treat it as a positive economic report. And then in the upcoming week, we're going to get the employment situation report, and that is the big report for the month. And then all the geopolitical things. There's Russia, Ukraine, and then now the U.S. is trying to get involved in that to see if they can get it to end somehow. We're kind of coming out of earnings season at this point. The bulk of earnings right now are kind of dropping off. The big one, of course, last week was Nvidia, and people just wait for that. And it wasn't all that well received, even though it was a really good earnings report. And we're going back and forth in the recession debate. There's folks out there that'll declare that we're going to go into a recession. There's other charts that we follow that say that we're not. Now, one thing that did happen this week, and I cover this in the daily video, the 10-year yield to the 3-month yield went inverted again. And that's one of the things that when it goes inverted and then it goes back to being normal, that's when we look at a countdown for going into a recession. Now, that's happened before, and we didn't go into a recession. So the other big yield curve that people follow is the 10-year to the 2-year yield curve. That's fine. That's still looking more normal. So I'm just kind of keeping an eye on that to see if there's some kind of recession that's going to happen down the road. And we don't just do things based on that. There's a lot of other charts that I look at, and I keep a close eye on these things and try to keep people informed based on the data, not what somebody's speculating, not what somebody who has a lot of fancy degrees tries to declare is going to happen. We try to look at the real data that we're given, and then what are the charts telling us? And then we had a few of the Fed governors come out and make some statements that said, we're probably not going to cut rates anytime soon. That didn't really help things on Thursday. Okay, now this is a change. We're actually looking a little more negative as far as our trend. We're not trending right now, and I'll show you the chart to back this up. But this week, we saw the red line go below the green line, or you could say the green line is now below the red line. So that's turning the default right now to negative. Now, like I said, in the bigger picture, yeah, we're seeing some weakness, but we're still looking okay. When you get down a little more focused, things have been a little bumpy. Now, in Friday's session, when we hit that 200-day moving average with the NASDAQ, is that going to see more follow through? Are we going to see more upside from that? And I'll show you some of the charts and kind of bring out what I'm seeing currently. Okay, just some bullet points. The major indexes or indices, if you want to say it the right way, they declined for the week and the NASDAQ turned negative for the year. And I'll show you some of these as well. The mid caps, small caps, they're really struggling right now too. The mega caps, which these are what really drive the market higher. Well, they didn't do all that well this past week. They had a couple of okay days, like Wednesday and Friday were pretty good, but Thursday was horrendous. And then Nvidia came out with their earnings report, and even though it was a great report, well, it wasn't really, really great. And so for the week, it ended up declining 7.1%. And that's such a huge stock. If that thing goes down, it pretty much takes the rest of the market down with it. And then there's this idea that you buy the dip, buy the dip. Oh, I'm looking for a buying opportunity, or I don't do that. Okay. And if you watch any of the videos and you kind of get involved with me, you'll realize that I don't do that because what's a dip? People, they look at a chart, they're maybe following things intraday, and then something goes down and there's a hint of it going up. Well, they think, oh, this is a great time to buy. And then it goes down even more. And there's a lot of people that tried that this past week and they got it handed to them, especially in Thursday's session. We saw a pretty significant sell-off going into the close. Now we got a lot of that back on Friday, but a lot of people that bought something in the morning were already losing by that afternoon and weren't probably all that happy. Okay, there are inflation worries about inflation going up and growth concerns, meaning economic growth may go down because we've got all these tariff proposals and things that nobody's really sure how that's going to work out. A lot of people have opinions, but we don't really know how it's going to go. And so there's some forecasts about that. Is this just a negotiating tool? And then because there's some tariffs that are supposed to kick in the upcoming week, and the market may not like that. Well, there's still a few days left as I record this, and they may try to come in and negotiate something to do something about those tariffs. And there's all this stuff that you probably heard about with Doge and everything. They're really trying to go in and cut government spending. And you got half the people who say this is terrible and half the people that say this is good. So, and then there's some of the economic data that's been coming out lately is a little softer than expected or hoped. Now, this is kind of interesting, and I'll show you a chart of this later. At the Atlanta Fed, now there's the Fed that meets and they have their Federal Open Mouth Committee that gets together to determine what's going to happen with interest rates. Well, there's all these other Fed branches around the country, and one of them is in Atlanta. And they came up with this tool called the GDP Now forecast. Well, I look at GDP charts every week when I do this video, and for the first time in a long, long time, we're actually seeing the forecast negative at minus 1.5%. Now that changes. They update this forecast quite often. So just because it's that way now doesn't mean it's going to stay that way. But it's kind of startling to see this being positive week after week when I look at the chart and show it in the video. And then all of a sudden it's shooting down. It had been at 2.3%. Now it's gone negative at 1.5%. And then President Trump did announce that tariffs for Canada and Mexico, they're going to start March 4th. That's Tuesday. And there's an additional 10% tariff for China that'll also go into effect on Tuesday. Okay, unless something happens to stop those things. And then he came out and said, well, we just might end up putting a 25% tariff on the EU. We're not sure when that's going to happen, but we are thinking about doing something like that. And then this happened on Friday. You probably heard about this. President Trump and Zelenskyy from Ukraine, they got in a pretty heated match in the Oval Office, no less. And basically, Trump came out and said, "You're gambling with World War III with your attitude." And then market participants were hopeful that there would be some kind of an agreement that was reached, but it didn't happen. So folks are a little bit disappointed about that. And then interest rates ended up going down, but it's not necessarily helping the market. What we saw over the past week is what's called a flight to quality. There's risk about inflation, there's risk about growth. That's when stocks thrive in a lower inflationary pro-growth environment. So you have some folks that are taking their money out of the stock market and putting it into the bond market. That's what typically happens when you see an economic slowdown. And because of that, they have to buy to get into the bond market. And so interest rates came down to 4.23%, where a week ago they were at 4.42%. But the dollar went up. It's still hanging in there fairly strong. It likes the tariffs. That just really helps the dollar. And then oil is actually under $70 a barrel. So we're not really seeing a lot of inflationary pressures there. We've been down, we were in the mid 70s for a while. We went to the upper 70s. Now we're actually dropping below 70 at this time. Okay, so for the week, the Dow was actually up 1%. And then you had the NASDAQ down 3.5%, the S&P down 1%, and small caps continue to be under pressure, down 1.5%. I show this every week just because this is a big picture look at what can happen with inflation. And are we starting to go back up now? That's all I want to take away from this is realizing that the way things are right now does not necessarily mean it's the way things are always going to be. And we don't know. We might be able to avoid what happened from 1966 to 1982, but we have been kind of tracking this kind of closely, and there are some inflation concerns that are coming back in. Is it going to lead to a real problem like we saw back in the mid to late 70s, which that's when I grew up, and I remember that quite well. Okay, then RenMac, and I show this chart every week too, because mainly what you see right here where I'm circling, they did a bunch of research, and you'll notice later on that earnings are still looking okay, but going out into the future, they're coming down with their forecasts. And some of that can be blamed on the 10-year yield being above 4.02%. Even though we've come down over this past week, we were up over 4.5%. Well, we're down at 4.23%, but we're still above the 4.02%, and that's biting into corporate profits, according to what RenMac found in a study they did. And I've been showing this for a long time. Okay, now this will be updated next week because this chart is updated when the employment report comes out. And then this was not updated. This is a week old now, but this just shows how forecasts for earnings going out are still up and to the right. Even though the numbers are lower than they were before, they're still projected to go up. And that's more positive for the market. Then we did get U.S. heavy truck sales, and we're seeing a little bit of an increase in the truck sales, but it's not as strong. I don't know. Like I keep saying, whenever I see this chart, is it drones? Is that how things are being delivered now? But it's been kind of choppy over the last few years. Then, quick poll question. What's the biggest risk to the U.S. exceptionalism theme? We are the best, America, America. All right now, it's inflation that, according to Goldman Sachs, they did some kind of a survey here, and they think inflation, where AI competition, this would have been number one about 2 or 3 weeks ago when DeepSeek came out. The tariffs, this will probably go up if those tariffs actually kick into gear. And growth, there are some concerns about that. I'd like to know what other is. You never know quite what that is. But yeah, there's some concerns out there. And then this is showing, according to Goldman Sachs again here, this is starting to go up. And that just means that the more this goes up, the more chance, according to this research, there is of a market decline. So you might want to pause and kind of read through this here a little bit. Okay, then FactSet. Now we're kind of out of earnings season right now. So now they're starting to look ahead. FactSet is a real good site for that kind of information. And it says the analysts are making larger cuts than average to earnings per share estimates for S&P 500 because we're the earnings that we've been getting were for the fourth quarter of 2024. Now we're starting to look ahead for the first quarter of 2025. And these charts just show that they're revising. And this happens a lot, but it's happening a little more than average right now. And the blue dash line right here, it's coming down a little bit. And this also looks out the first 2 months of the year, how they're coming down with their estimates. And this also shows how things are coming down. They're not turning negative. They're just revising these things down currently. All right, now here's the intraday chart. And we go all the way back to Monday here, and things were looking okay, but then we saw some real weakness going into Tuesday. That happened right at the open, but then we saw some strength coming back into the market later on. And I have this thing that I say in the daily videos and in the courses that I have. It's the amateurs who open the market, it's the professionals who close it. Let whatever's going to happen at the open, we just kind of sit back and watch that. I never make decisions during that time. I want to focus on the close. It's the professionals who drive prices going into the close. And we saw, even though we had a down day, we saw some good intraday action coming back here. Even if you're not a day trader, even if this is just something to watch, you can see the interplay going on in the market. And I have a lot of different charts that I follow during the day. Then on Wednesday, it's like, aha, we have a strong open here. And we hit the 50-period moving average with the Dow. And then we spent the afternoon coming down. So that kind of blew the sails out there. And then Thursday was the real negative day. We actually had a higher open and gyrated around a number of times. And then later in the day, boom, 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 we just went down, down, down. Then on Friday, and I don't know why, but with stockcharts.com, for some reason, there was no volume data on an intraday basis here. And we came down here, and this is about the area where we hit the 200-day moving average with the NASDAQ. And we built up a bit of a base here. And then later in the day, we saw some buying coming in, and we ended up closing right at the high. So if you look at Friday's close and Wednesday's close, they're right about at the same place. So it's kind of interesting. You take out Thursday and Friday, we could have had a 4-day weekend. All right, now looking at the sectors for the week, sorry, the indexes for the week. The Dow, now this is just the 5 days, Monday through Friday. I don't go from Friday to Friday with these charts. There's other charts that we do go from Friday to Friday. But the Dow was up, the NYSE. This is the broad market, and that's encouraging. Not up very much, but it was up, where you had the mid caps and the small caps, and even the S&P ended up being down with the NASDAQ and NASDAQ 100 being down for the week. Now, going back to the beginning of the year, though, small caps are down the most, followed by the NASDAQ, mid caps, and the NASDAQ 100. S&P is still positive. It would be negative right now if we didn't have that advance on Friday. And the Dow is up, and then you have the NYSE, and this is encouraging. This is a broad market measure, and to see the broader market doing well. But what we're also seeing is this switch from growth stocks into value stocks. We're seeing some rotation going on, and what we're trying to evaluate day by day is that going to continue. This is what we saw, something similar play out at the end of 2021 going into 2022, which was a cyclical bear market for the 2022. We finally bottomed in October of 2022. Now, we don't know. We're still at that point where we could bounce up out of this. But this is happening, and we want to take note of this and be aware of it. I would much rather be aware of something and not need it than to be caught off guard and say, how come I didn't know about this? That's why I look at a lot of different charts. That's why I do so many videos, to try to get as much information as we can. Even if we don't necessarily need it, it can still be useful for making decisions. Now, looking at the sectors here, Looking back over the week, we had a down week. Tech got hammered. It was down almost 4%. Utilities were down. Discretionary, that's another growth area, was down. And communication, another growth area. Where you had the financial sector, and this is encouraging that the financial sector is doing quite well, and it was the strongest sector. We saw a little bit of a bounce here with real estate, healthcare. These tend to be more defensive. Staples, another defensive area. And then some of these are what we call cyclical. If the economy's doing better, they go up. If the economy's showing weakness, they go down. But some of these areas have really been hammered pretty hard. Then I sort it different over here based on a score of 0 to 100. And right now, the financial sector, it's looking really good. High 90s, that's a solid looking sector. And then communication, even though it got hit this past week, it's still at 96.4. And then we get a little bit softer here with discretionary, staples, utilities, and then we still have materials. They improved. They were up 7.8%, 0.78%, but they're still the weakest sector of all. And tech has been under pressure lately too. And healthcare, which bounced up this week, but still it's not all that strong. Usually 50, above 50, it's looking more positive. Below 50, it's more negative. But I don't really look at things until we get into the 80s, high 80s, low 90s. That's when that particular part of the market is really showing more strength. All right, then looking at the sectors here, this is for the week where tech was down, communication were down. These are two growth areas here. Discretionary, that's also been under pressure too. Or the other sectors, see, a lot of the financials did well in real estate, and some of these are considered to be more defensive. Now, going back to the beginning of 2025, discretionary and tech are the weak areas. So far to this point. Now, this could come back, but we're losing that momentum that we seem to have back in 2024. It just hasn't really carried through on a consistent basis so far in 2025. And that's what we're watching day by day to see if that changes. Then looking at this in a little different way, if you remember back to your geometry class where you have the x-axis and the y-axis, in the green area, that's a plus plus. The red area, that's a minus minus. So these are the weaker areas down here. And we're seeing kind of weakness. The financials are doing better. Now, this goes back over the last year, not just the last week or month or two. This is taking a longer term look at things. And then we have communication, which is still one of the stronger areas, but even it's been getting hit a little harder lately. And then tech or discretionary, I'm sorry, it's been going back to last August up until the end of 2024, it was the best performing sector. Now it's been under pressure, and a lot of that has to do with recent weakness that we've seen in Tesla. Or a lot of these other areas that some of these are more defensive have been coming on and showing some strength, but they're not turning blue and they're not going up to the green area, at least yet. This is designed to look at this over a longer period of time to see bigger moves that last longer, not just moves that last a short period of time. And this shows how these blue areas, these are the ones that are showing improvement. The red areas are showing weakness. The yellow areas are more neutral. And then the ones that are more positive are communication right now. They're green. Then we look at the indexes where the NASDAQ 100, it's been the real leader, but even it's seeing some weakness, as is the S&P 100, the S&P 500. Now, this is because of the other stocks in the S&P 500, not necessarily the mega caps, not the really big, the large cap growth stocks. Other parts of the S&P have been showing some improvement. So we look at charts of the S&P 500 and it's holding up fairly well. You look at the advanced decline line, you look at the new highs, new lows, it's doing okay. But it's the big stocks that aren't really helping the index right now. In fact, they're kind of hurting the index. Okay, then we look at it over here where the S&P is still looking fairly strong. It's one of the reasons why I pick it out because it's more balanced and I focus on that. Where we're seeing some weakness in these other areas with the NASDAQ 100, those are the big mega cap stocks, which are also included in the S&P 500. And then the S&P 100, which are the biggest stocks that make up the S&P 500. Okay, as far as sentiment, we are extreme negative right now. We were actually lower than this after Thursday. We did tick up a little bit, but this, when we get a really low reading like this, we don't immediately adopt this, but we start to entertain the idea of using this as a contrarian indicator. when you get folks that are they're all pessimistic, they think the market's going down, everything's looking negative, that's when you want to start at least considering the idea of buying. You want to do the opposite of what your emotions are telling you. And then we can see this on a chart. Now, this is negative when it's going down, but when we drop below 25, we bounced up a little bit on Friday. If this keeps going up, that's going to be more positive for the market. And there's nothing to say that we can't even go lower. I mean, this goes all the way to zero. Now, it's very rare that we get that far, but theoretically, that could happen. Another sentiment gauge finally dropping below zero and actually going negative right now, put out by Goldman Sachs. The active asset managers, they were a little bit more positive a week ago. They've pulled back from that. And here's another look at this coming in at 87.7. And these are professional money managers who are human beings too. And they use their emotions and they have peer pressure and they tend to chase things that have already gone up and sell things that have already gone down and just the way it works. But these are professionals. And so we want to track what they're doing. Now, as far as the fear gauge, the VIX, we're really going up with the VIX. Now, after Thursday, we were above 20. Now, we did come back down and we closed below 20, but still we're getting a high reading from this as fear is increasing. And on the daily side, the momentum of the VIX is now up, and that's more negative for stocks. This is still looking okay, even though it's taking a bit of a hit. When we look at a ratio between cash, T-bills, and the tech sector's been a little bit weak, but yeah, this line's going back up, but we're still not above this red line here yet. The overall pattern has been a decline, which that means the tech sector is outperforming cash. We look at the RIDEX bear bull ratio. When this really spikes up, folks are freaking out. When we're getting really low readings, that means they're more positive on things, and it did increase. But there's a 1 day lag on this. This is from Thursday. So we're probably going to get Friday's chart on Monday, and they'll see a big spike in this because they would have freaked out after Thursday. They would have sold on Thursday, and then we went up on Friday, and so now they'll be positive again. It's a real whipsaw thing that can happen. And now this could end up being positive. The American Association of Individual Investors, of which I'm a member and have been for a long time, but they're getting very pessimistic about things. When we drop below this 30 level, or is that a 20 level? It's hard for me to see this. We haven't seen this low a reading in a long time. And when it gets really low like this is another one that we use as a contrarian indicator. So, but they're also getting longer term negative. The moving average, it's a 50-period moving average that I use here. It's going down as well. And the Ulcer Index, now on the daily side, we're above this moving average. Here, we're still below it. We haven't seen a real pickup in fear longer term yet, according to that chart. And then we look at the spread between risky and not as risky options. Now, if the economy was going to fall apart, we would see this really spiking up. It's not what's happening here. Now, it did go up a little bit, which means it went down here. This is an inverted chart. If this really starts to drop, we would be concerned, but it's still showing that there's not a lot of fear in the bond market right now. It increased a little bit, but it actually ticked back down just a little bit on Friday. This is a daily chart that I show here. And we look at the VIX, the fear gauge with the 3-month average of the VIX, and then do a ratio. It's poking up a little bit, but we're not seeing an awful lot of conviction. And this kind of goes hand in hand with the loss of momentum that we've seen going back to the beginning of 2025. But longer term, we're still declining. When we look at the equity put call ratio going back 253 periods, that's an actual number of days that are in a year. With this going down, that's more positive. All right. Now, looking at the economy, this is updated every week. If the economy was getting ready to fall apart, according to the Financial Conditions Index, we would be up to this black line, and it's actually going down. This is the GDP now. We've been humming along up over 2% now for a while. And then the latest reading, boom, went down under about 1.5%. And that has some folks concerned for the time being. We look at it here, another way to measure this. And when I show this, I say, look at all these, they're positive. Well, now we have one that could potentially be negative. Now, the definition, one of the definitions of a recession is that we have two of these, because this is per quarter, two of these are negative back to back. And you take that in conjunction with other charts to determine whether we're in a recession. And then there's the NBER. They're the information source that actually declare if we're in a recession or not. And I keep an eye on their charts, and they're still holding up. Now, this Friday will probably be more telling with the employment report coming out, because for the most part, the employment situation is strong. And so it's a lot harder for the economy to go into a recession if employment is still doing quite well. Then this will be updated in a week. It was last updated at the beginning of February. This one was updated here, but we're not even up to the black line right now. When we really get nervous is if we go all the way up to the red line, and we're actually going down currently. This also just gets updated once a quarter. There are periodic updates throughout the month, but this has been coming down lately as well. As far as inflation, we did get the core PCE on Friday. That's why you saw some adjustments here. And things are readjusting now for CPI as well. And then it's a 96% chance that when the Fed meets on March 19th, they're going to leave rates exactly where they're at. And that's become even more locked in. The Fed has pretty much come out and said, we're not going to cut rates for a while now. And then we look out to the May 7th meeting, there's an 85.5% chance the rates are going to be the same after that meeting, too. And that's even becoming more of the conviction of the market. We keep an eye on the Fed balance sheet, which has been declining since June of 2022. And we look at a year-over-year basis here, where it's kind of been going up. It isn't going down on a year-over-year basis, at least yet. And we want to keep an eye on this. We're seeing a little bit of a spike up here. These are the overnight reverse repurchase agreements. And we just keep an eye on this to see if anything really weird is happening. Well, there's a bit of a spike up recently. If this continues to go up, yeah, we might get a little bit more concerned. But other times this spiked up, it came right back down. Okay, now looking at our charts, the advanced decline line here, we're still looking pretty good on the daily side. We're positive here on the weekly side based on price and volume. We're above advancing moving averages. The new highs, new lows, a lot more new highs than new lows. So we're going up with the 4-week and we're starting to turn back up with the 10-week. So internally, things are holding up. We did see some weakness with our advanced decline ratio, but they both ticked up this past week. On a shorter term basis, 19 weeks, it's still negative, but we're going back up with the 39-week. Okay, then is our trend. This is where we switched and looked a little more negative now because the red line has crossed above the green line. Now we're still not trending. We did start a trend on the daily side, both in the short and intermediate term, and the red line's on top in both of those charts. So that's negative, and we're turning more negative on the weekly chart. So yeah, we're picking up some weakness right now. You can just look where we are. We haven't really gone much of anywhere so far for 2025. And we saw some selling this week. And so we saw the red line go up and the green line go down. Now, when this turns up, this dark line, that's the actual indicator itself. And it crosses back above the moving average, which I put on here just to give it some context. That means the trend is getting stronger. So for right now, we're still in a weakening trending environment where we're starting to show a strengthening trending environment on the daily side. Okay, this is the Arun indicator, which is negative now on the daily charts. It's still positive here on the weekly chart. And no signals being generated here, so I won't talk about that. This is a daily chart. It's a little bit hard to read because now we have the pivot points coming in for March. And this is what I update every day on the YouTube community tab. Only I include each day's bar in there to give you a little bit more of a reference of what's actually happening. And even though we're pulling back longer term, the trend is still up. Yeah, we're pulling back up here with the 50-week moving average, but we're still above the moving average and everything's going up. This is the pivot points that last for a whole quarter. This is a weekly chart. And we're getting some new pivot points that will be drawn in here. And so we'll just keep an eye on this. We're right in between things currently. So it's if we go up, that'll be resistance. If we come down, that may act as support. In a very general sense, the fact that we're above the pivot, the P right here, above pivot is more positive, below the pivot is more negative. I've been just hammering this in the daily video. We hit this upper end of this trend channel going back to 2009 in about December 6th. That's when we set the previous all-time high for the S&P. We've been having a really hard time doing much since then. And this could be part of the culprit here. Now, we did go above this back in 2021, but then that led into 2022. Right now, though, we haven't been able to get above this. Now, I use a moving average crossover system here, a 13-week moving average and a 50-week moving average. We're falling a bit below the blue, which is the 13-week moving average, but the blue's still above the red, and we're still going up. So this is why I say the long-term trend, the positive trend, is still intact. Then we have a smart money indicator here. And this is actually a little bit accurate. We're getting on really crazy readings on the daily side. We came down, but we're still above this advancing moving average. That's why this is positive for the time being. If we drop below the red line, that's when it turns negative. So as long as we stay above this, we're still positive. And this measures what is the smart money doing? Because we want to be doing what they're doing. We don't want to go against them. We want to figure out what are they doing and then just jump on and do the same thing. All right, this is smart money indicator number 2, which is now declining. It's positive since it's green, but the histogram is going down and the red line's also going down. We're also going down with smart money indicator number 3, the Chaikin oscillator. It's still above the midpoint, but it's dropping below its moving average. So this is picking up the weakness that we've been seeing, but it hasn't necessarily turned full-blown negative, at least yet. And we actually went up a little bit with the McClellan oscillator. We're back above zero. And we're still above zero with the summation index based on price. Even though we declined, we're still above zero based on volume. We declined, but we're still above zero based on price with the Swanland trading oscillator. But we did drop down. And that's what we're seeing lately, too. Because it's the mega caps that are getting sold right now and they do a lot more volume. That's why you're seeing this getting picked up and actually turning more negative. Volume is actually leading price right now. Now, a couple of weeks ago, I was pointing that out as a positive thing. And because when volume leads price to the upside, that's usually a good thing. And then we hit a couple of all-time highs, but then we've been seeing a shift since then where volume has been leading price to the downside. And then we look at the momentum. We're negative, and we never did really turn positive here. The PMO is going down. We declined based on price and volume here. Saw a little bit of an improvement with the PMOs inside of the S&P 500. These are all 503 PMOs. Saw a little bit of an increase with those that are going up, a little bit of a decrease with the buy signals, and we're starting to roll over with the PMOs that are above zero. So a little bit of weakness showing up here. And we're dropping below 50 with the bullish percent index. This is negative, both on the daily side and here on the weekly side. And we're right at the midpoint here with the Bollinger Bands. We did close below the Bollinger Band, the lower one, after Thursday, but then we bounced back up. This is a weekly chart where we're starting to drop a little bit below the midpoint. That's tilting things a little more negative for the time being. Momentum, we're going down. Now, it's not that we're crashing or anything like that. It's we ran out of going up. And so because of the way these indicators are calculated, as weeks go by, higher numbers are being calculated and they're not seeing much of a change. And these indicators can't help but go down. And we're pretty much negative across the board. I use the daily ones. I watch those a little more closely. They're turning negative too. But this is more a victim of how they're calculated. But this can also be a self-fulfilling prophecy because people see this, oh, we're going down, down, down. I'm negative too. But it also, you have to look a little deeper under the surface for the way these are actually put together. Okay, we're also declining with the Copic curve. We're also negative on the daily side there. We're negative both on the daily side and here on the weekly side with the force index. We're below 50 and declining with the money flow, and we're negative on the daily side. We had another down week, so we're below zero here with the week over week change. And we are declining here when you look back over the last 50 weeks, where we're seeing some longer term weakness. And we're starting to get extreme now with the Stochh RSI, but it could stay down here for a while if we see more follow through weakness. And we're still above 50, though, with the ultimate oscillator. And we're coming down after being extreme positive with the Williams percent R. And we're Still positive here with the vortex, but the green line's coming down and the red line's going up. If we see a cross, that's going to turn this negative. And we're also negative on the daily side already with this indicator. We're still positive here with the long-term oscillator, the special K. And we're a little bit below this 10-week moving average here. And see how the moving average is just flat for all of 2025? That means we're really not going anywhere. We're not really seeing any momentum right now. Now, what we're going to be watching is if there's more weakness, we're going to be coming down to this 40-week moving average and see if that provides some kind of support. If we break below that, things are going to turn more negative. If we can get back above this 10-week moving average, that will turn things back more positive. And we're declining, but still above 50 with the RSI for 14 weeks. And we're negative on the daily side. I use a 9 period, which is 9 days, and a 14-day. And those are both negative now. And I don't know why. This is last week's chart. Okay, something didn't get deleted here, so I'm just going to go through this because I don't want to go back and do this again. Okay. So sorry about that. I thought I had edited all of this from a week ago, but apparently I did not. Okay. Now, we are looking a little bit more negative right now with the Heiken Ash sheet. This is another way of looking at the trend. And when the candles are open, that's positive. When they're dark or black like this, that's more negative. We're red and pointing down with the Kegi chart. That's more negative, but we're still positive with the Renko chart. It hasn't picked up enough of a decline yet to change this. But we're turning more negative with the three-line break, another way of being able to measure the trend. And we're dropping below the midpoint here with the ease of movement based on 14 weeks. And we were down enough here to draw in some O's. Going down, we draw the O's. Going up are the X's. And this is a double bottom breakdown. We're seeing the same signal on the daily side. And yeah, there's some weakness that's being picked up here. Seeing some longer term weakness right now, intermediate term weakness, and we're actually negative already in the short term. But these are still even though this is short term, this is still a weekly chart. And we've gone neutral to negative with the Elder's Impulse system for the S&P. It's picking up some weakness as well. But we're still positive with the parabolic SAR. Now, if a dot comes in on top, that's going to turn this more negative. But for the time being, we haven't seen enough of a decline yet to turn this chart negative. We are negative on the daily side. All right. And then looking more shorter term here, we're negative with all the indexes where the mid caps and small caps are negative in the intermediate term. And then we've seen some weakness recently in commodities, and bonds have been improving both in the short and intermediate term. And the dollar is now back in an uptrend in the short, intermediate, and long term, where it had been in a downtrend. And then this is just looking at the indexes themselves with the S&P, and you can see where the mid caps are negatively diverging, where we've been holding up better with the S&P. We've been declining with the mid caps and declining with the small caps. Now, looking at the Dow, it's a little bit stronger right now, and it's still at its 13-week moving average and still in an uptrend. And then the NASDAQ. Now, this won't show what I saw in Friday's session because that's a 200-week moving average here. We didn't come all the way down to this red line, but this has been showing some weakness, but we're still in an uptrend here. We're also showing some weakness, but in an uptrend with the NASDAQ 100. This is the QQQs, which we've seen 2 down weeks now. Those are the red candles. The mid caps, they're starting to see more weakness. We're falling down below the 50-week moving average, and we're a little bit below the 50-week moving average here with the small caps. They just haven't lived up to what a lot of people were hoping for. And the NYSE, it's above its moving average. So this is actually holding up better. And this is a daily chart of the Wilshire where we fell down below the 50-day moving average, but it's still in a longer term uptrend. All stocks pulling back, but still haven't come down to the moving average. And we're falling below the 13-week moving average with the FANG index. This is another mega cap index that we follow. ARC really fell. It was down 7.5% on the week. It had been looking on better and in an uptrend, and it's still in an uptrend, but it got hammered pretty hard this past week. But the banks looking okay, not really moving around all that much, still above 50 with the RSI, but the momentum is still looking negative going back to late December. And now we're switching over to March. We're going back to 2021. We've been up every year. 2021, 22, 23, 24. So we'll see. Is 2025 going to be positive too? With the return of 3.6% over that average over the period of time. And then looking at just the indexes themselves, where we have the Dow on top, it's not back to its all-time high, but it's holding up a little bit better, where we've been seeing some weakness in the transports as well as the utilities. Then looking at commodities, now they've been in an uptrend and they're still in an uptrend here, but they're coming back down to their 13-week moving average. We're dropping below 70 with oil. And then we look at the dollar, which is still in an uptrend, had been really pulling back. Now it's starting to go back up. And copper just on the verge on the daily side of going into an uptrend. Where here on the weekly chart, it's still in an uptrend. Gold got hammered pretty hard this past week, but it's still in a solid uptrend. Silver came down, but it's still in an uptrend as well. Then we look at bond prices, which have been improving. So when bond prices go up, that means interest rates are going down. And we look at a stock to bond ratio where bonds actually did better this past week than stocks. And so that's why we're seeing this ratio coming down a bit. This is a daily chart where we've been declining with yields across the board here. Then this is a weekly chart, and we show the US, UK rates, which have been coming down, German rates. We've been really focusing on this red line, which is Japan, because their rates are going up, and the rates going up last summer are what caused that really big down day that we saw in August. So we're wondering if something like that could happen again. Now, going through our intermarket analysis chart, even though gold's been coming down, it's still the best performing asset going back to the beginning of 2025. And then, believe it or not, bonds based on price are in second place. And then stocks are kind of eking out a little bit of a gain here. And then we have oil, and then we have the dollar. But everything's positive now, but we're seeing a little bit of weakness in in gold, as we're seeing a little bit of strength in bonds. And we look at some ratios between the NASDAQ 100 and the S&P. The NASDAQ 100 has been underperforming, but it's still in an uptrend compared to the S&P, even though they both have done really well. And then the S&P 100 showing some weakness when compared to the S&P 500, but longer term, the S&P 100 is still outperforming. And this is what we would see in a positive environment. Another big thing that I've really been focused on lately is the growth to value ratio. I have lots of different studies and lots of different daily charts. Yeah, it's coming down here, but it hasn't changed the longer term trend. We're seeing more weakness on the daily charts, but we're still seeing some uptrends that are holding on the daily side as well. And then not much of an edge here when you compare gold to the S&P. We've just been kind of going sideways here. And then gold is now, it was down and the dollar was up, so that's why we're seeing a recent decline here. But overall, gold has been outperforming the dollar longer term. Bonds coming up, but still in the longer term, bonds are still underperforming stocks. And then discretionary to staples, another area that has just really been strong since the beginning of the year. It's been pulling back, but it's in an uptrend when compared to staples. Discretionary is more growth, staples are more defensive. And if you look back here in late 2021, we started to see this change. And this is when this ratio is really going up here, that means it was getting out of hand. And then we saw this really coming down. And this was the bear market that we had back in 2022. So, yeah, we're watching this, but it hasn't changed to the same thing that we were seeing before. And then low volatility stocks, this is another defensive area. It's in a longer term downtrend, but it has been bouncing back up. When this outperforms, that means the market is getting more defensive. It hasn't switched yet like it did going into 2022. We're just watching this for right now. And then energy, which has been bouncing up compared to tech, but still it's been underperforming longer term. Then small caps, which are just not doing well. The tech sector, which has been under pressure, but small caps have been even worse. But you look at this ratio, it's just been chopping along. It hasn't really been doing all that much. Then longer term, we look at the NYSE breadth thrust. Not too much to see there. No recent signals with the swag NYSE breadth thrust. This is longer term with the S&P, a weekly chart, still above this long-term trend line going back to the 1987 crash. We're still on a full-on buy signal with the Zohorchak method. That hasn't changed yet. That doesn't change very often, but when it does, we notice. And a weekly chart of the NASDAQ 100. We did fall a bit below this long-term trend line going back to 2009, but we're still hanging in the general vicinity for right now. And then we look at a 50-period moving average of the new highs, new lows for the S&P, just kind of chopping along, not really doing much. And then we look at the NYSE new highs, new lows, and a 50-period moving average. This has actually been declining a little bit, but it's still above zero. And then we look at a ratio between the NASDAQ 100 and the Dow. This is still holding up. It's not dropping below this red line. And we look at the QQQs with small caps still above this my goodness, blue line right here. All right, then we want to keep an eye on the 3-month yield. It's been pretty much chopping sideways going back to the beginning of the year. And then the cumulative new highs and lows for the NASDAQ trailing off a little bit after it had been improving. Then seasonally, what do we look like for March? Going back to 1964, the average return is up 1%, 65% of the time. So we see things a little bit better when it's zero for February and it's up 53% of the time. And then we're still in that positive window, which started in November and goes through till April, where the average percent change is up 7.5%, 77% of the time. This is considered to be the strongest part of the year. But when you look at February, it's the weakest part in a post-election year. And now we're into March, where the first part of March, the first half, it's the second performing area going back to 1950 and taking a median return there. The second half trails off, but it's still positive, where we just came out of the second half of February, what tends to be negative. And this also shows after an election year, the first quarter really doesn't show all that much. And we got January, February, and March for the first quarter. And then this is a composite. You take the 1 year, the 4 year, 10-year cycles and try to combine it all together. And this is about where we're at right now. So if we stick to what this chart says, we might see some upward movement from here. But things are going to stay kind of sideways. And then it'll be later on in the year when things actually turn more positive, according to this. But there's no guarantee that this is going to happen. This is just something that we use as a guide. So thank you. I really hope you found this helpful. Please feel free to leave a comment or send me an email. Let me know what you think. If you have any feedback that you want to give, here's an email address where you can talk to me that way if you desire to. So have a really good weekend, and I will talk to you in the next video.